What's good, everybody? Welcome to episode 2 of the Bootcamp. Today, we are going to be talking about what actually moves the market. So, there's two things that move the market. That is price returning to inefficiencies, so fair value gaps, and price seeking either highs or lows, known as liquidity sweeps. So, let's jump straight into it. First of all, you're going to want to know where high or low is. So, if we look on the chart here, we can clearly see we have move up, move down. So this candle here would be our low. Then we have another move up. This is our high. Sorry, I forgot to mention the high here is also a high. So move up, move down, that creates a high. Then move down, then moving up creates a low. Then it moves down again, creates a high. Pretty simple. It's literally basic market structure. Move up, move down, high, moves up again, that's a low, new high if it moves back down. Simple. So, if we're looking for liquidity sweeps at highs and lows, I've accidentally mapped one out here, which is pretty much a perfect example. We want to see price, if we're looking for a liquidity sweep of the high or low, we want to see price come up past the most recent high, take out any sellers that had their stop losses there or at break even, to then see the move down. We must move higher to move lower. Understand? Very nice. So, what we see is market makes a new high, price comes up, we sweep the high, and then we start seeing a big sell off all the way down to our resting liquidity draws, which would be these lows, these lows. That was like a perfect example of a liquidity sweep to then target other liquidity. So, let's try and look for a few more examples. You can see them everywhere. Yeah, price action this week has been absolutely terrible. That fucking disgusting. It's not been fun trading the past 2 weeks, but NFP tomorrow, hopefully we'll get some nicer price action after NFP next week, because that is just sickening. But yeah, let's not look at that and damage our eyes anymore. Let's look for some more liquidity sweeps. So, here we go. This is a good example of a low being swept rather than a high. So what we see is price is, we push up, make a high, come down, make a new low. After price moved up, there we go. Price comes up, make a new high, so that's definitely our low. What we see is price come down, we take out the low, and then we start pushing up to take out the highs, such as these ones, these ones. You get the gist. Market will only move between highs and lows. And what was the other one I said? Fair value gaps. So we'll jump into some fair value gaps in a minute. We'll just map out a few more highs. Let's see here. It even happens in this little time frame. Even in this little section here, what we see is move down, move up. This is a low. Price comes down. We sweep out the low. We push higher. The market only moves from highs and lows and fair value gaps. Let's see, is there any more? Yeah, there is a few more, but I've actually noticed a really good example of a fair value gap and a low being swept. So what we see here is, well, first off, we see this low being swept. See this low being swept, we get a leg up, we come and take out this high. It's once you start seeing this stuff, it becomes so clear where price wants to go. So let's get into the fair value gap I was talking about. This one here. We see price expand all the way up. We see this fair value gap form. Price sweeps the low, comes into the fair value gap, and then we start seeing legs up. Where does it look like it's wanting to go? Well, into this huge fair value gap here. Sweep the low, tap a fair value gap, come for a fair value gap. It's really that simple. I could show you this on multiple time frames. I'm currently in the hourly, but this happens on every single time frame. We go into the 15-minute. Let's see. I'm trying to find good examples that are nice and obvious for you. This is a good one. So what we see is we see a liquidity sweep of these highs. Price comes up, we take out those highs. Then we start coming down. We start pulling it into this fair value gap here. You can use your fair value gap for entries. We respect the fair value gap. We would enter short after the respect of the fair value gap. Why is that so big? With a stops just above the high, or the gap even, sorry. Just above the gap, targeting some sort of resting liquidity or another fair value gap. In this case, the resting liquidity would be these equal lows here. This is a trade I would take any day. This is during the time I trade as well. So 2:30 New York session open. The session opens, we sweep the high. We end up getting a break of structure here. That is your break of structure in the lower time frame. Price comes back, we respect this fair value gap, and we come down for liquidity. All of this buy side liquidity here is your probably TP1, and then for an extended TP, these equal lows all the way down here. There's also a fair value gap to target. Price only comes for highs, lows, and fair value gaps. That is the only thing that moves the market. If you caught this trade, you'd risking what 1% on a 100k account, you'd be up 4,600. Let's have a look at some more. Let's just spam loads of these liquidity sweeps. So here's another example of price seeking fair value gaps. So what we see is price comes into this fair value gap, and then what do we see? We see price push down, come into this fair value gap. They just bounce from highs, lows, and fair value gaps. That is all price does. It's an algorithm. It is designed that way to move from highs, lows, and fair value gaps. So let's see here. Price sweeps this high. Where do we come? For this fair value gap to rebalance this price. Then once we've rebalanced this price, where do we come? We come for this high. It couldn't get any easier. After sweeping that high, where do we come? Come for this low. After sweeping this low, where do we go? We come for these highs, or even on a higher time frame. Let's have a look. Where did price ended up wanting to go from there? Oh, I've lost it. Price wanted to come And guess where it's filled? This fair value gap. Swept the lows, came for a fair value gap. We came into that fair value gap. We've respected it. Where do we come? Let's get rid of some of this. It's a bit messy in the minute, isn't it? So after that sweep, we've come into this fair value gap. Price drops. Oh, let's see where it's going. Came for all of this liquidity at these lows. The more relative lows, the stronger the draw on liquidity. What's price doing at the minute? We see on a higher time frame, price. No, we didn't quite sweep out this low. But yeah, here we go. Sorry. Completely blanked there for a minute. What we see is price come. We sweep out these lows. We fill this imbalance. And where do we come? For these highs and this fair value gap. What's price doing right now? That was Tuesday. It's Thursday today. So what do we see price do now? We've filled in this imbalance on the 1 hour. Filled in this imbalance. Where we come in? For these highs. What have we seen after we swept these highs? Let's go into a lower time frame. We swept these highs. Where have we come? This 15-minute fair value gap. As it's just in front of you. Like, I don't quite understand how people can't see it. It is literally the only thing that moves the market. If you can spot highs and lows being swept and fair value gaps, you can easily make money. There's other things for your confluence and your strategies, but the two main important factors that you need to know is where liquidity lies and where the market is wanting to go next. Let's draw some examples. My drawings are always a bit shabby, so bear with me. So, what we see is price. We'll do an accumulation range. What we see is price accumulating. We're making equal highs, equal lows. We're just in a shitty range. Then we see price come up. We sweep out these highs. Then we start to see a sell-off back to the lows. This is your liquidity sweep. Then where's it going to target next? The opposite side of liquidity. The same thing for bullish market structure. We see the lows being swept. Where does price want to go? To the highs. There's potentially a big high time frame fair value gap here that the market wants to seek to rebalance. Say there's a fair value gap here. We swept out the lows. We have enough momentum to come for that fair value gap and take out these highs. I can show you this on a daily time frame as well. This happens on literally every time frame. Get rid of all of this. Well, this week's a bit ugly, so let's move away from that. I don't want to absolutely kill your eyes. So, what do we see? Price comes down. We sweep out this low. Make that white again. Nice and obvious. So we sweep this low. Where does price come? For this high. We sweep that high. Where does price come? Fill this imbalance. We fill that imbalance. On a lower time frame, there's probably another fair value gap here. Let's have a look. Yeah, exactly what I thought. This is why using multiple time frames is a good idea. So what we see is maybe the 2 hour. Yeah, there we go. The 2 hours nicer. So what we see is price at the highs. We came for this fair value gap on the 2 hour. We come into that fair value gap. Where do we go next? Oh, lo and behold, these highs. This fair value gap. And these highs. The price only moves between highs, lows, and fair value gaps. I really need you to understand this because it is literally the only thing that moves the market. Fundamental data, yeah, sure, it moves the market, but where does it go? Well, let's take a look at some news events. So if we try find the first Friday of, this is August, so first Friday, usually an NFP release. Here we go. This will be an NFP release. So, fundamental data comes in at 1 o'clock, 1:30 most likely, UK time. Where does price move because of the fundamental data? This low. And probably another low. On a much higher time frame. Yeah, all these relative lows down here. It's priced in to move all the way down here. I didn't quite get that one. So we sweep out those lows. Then where do we come? Oh. These highs. What else does it come for? After sweeping those highs? Guess where we end up? Pulling into this fair value gap. We have a liquidity sweep in here as well. What do we see? We see price come down, we sweep out these lows, and then what? We come for these highs, these relative equal highs. What else do we see? We also see this fair value gap. It doesn't get any simpler. What else do we see? So, we've come up. Did we fill this fair value gap? No, didn't quite fill that fair value gap, but we've taken out all of this liquidity, all these highs. What do we see? Price comes up. Oh, we've taken all the liquidity. We've stopped everybody out. Where does price want to go? Oh, we take out this low. We take out this low here. And where do we come into? We come into this fat fucking fair value gap. Where does it go after that? Oh, and behold, it goes to this high. It doesn't get any easier. And I don't think I could go on for hours showing you all the different liquidity sweeps, all the different fair value gaps price comes into. I'll do one more. I've just seen it. This is the last one because we could be here for hours. So what we see is price comes up, we sweep this high. Where does it come? Oh, take out this low, this low, this low. And it pulls into this fair value gap. Once we pull into the fair value gap, where does it go? This motherfucking high. It doesn't get any easier, people. I could sit here for hours showing you multiple liquidity sweeps, but I think you get the gist by now. That's it for Bootcamp episode 2. I'm going to be doing, next episode, we're going to be talking about breaks of structure. And then, actually, no. Next episode, I'll talk about how to find fair value gaps, how to find the best probability fair value gaps using premium discount zones. So that'll be next episode. We'll be talking solely about fair value gaps, how to spot them, how to find the best ones to trade, and how to use Fibonacci tools to find the best one to trade. Yeah, that's it for episode 2. Catch you in Bootcamp episode 3, boys. Have a good one.